Fed Chair Jay Powell and the FOMC begin their two-day meeting now with expectations of further support, but will there be anything new in addition to the bonds that they're already buying up? Let's bring in Jim Masturzo, partner and head of asset allocation at Research Affiliates. Jim, welcome back to the show. What should we expect from the Fed? Can they do anything until they know what the fiscal side is going to be?
Hey, Oliver. Of course, they can always do something. That's not necessarily our base case. We're really not expecting a whole lot to come out of the meeting this week until we see something on the fiscal side, whether that be, later this week or we have to wait until January.
So if they don't do anything new, right now they're buying a bunch of bonds. The expectation is that that's going to stay the same. Maybe they tweak some of the language about how long that program can go on for. I think that's the consensus view right now. I think there's a significant probability assigned, according to some of the stuff that I've read and some of the surveys here, about them actually either changing the duration of the bonds that they're buying, maybe increasing the program. But I still think that remains a minority view. So I want to go through a few of these possible scenarios of what it means for you as an asset allocator when you think about treasuries and fixed income. So if they hit the consensus and they just change some language, what does that mean for bonds, Jim?
Really not a lot in the short term. Now, we're expecting, and what will be interesting coming out of the meeting and some of the notes is what they say about yield curve targeting. I personally think that they'll do some sort of yield curve targeting next year, which basically means they'll peg something out on the curve, whether it be the 10-year or maybe something more like the 2 or the 5-year, and actually target a specific duration. So it'll be interesting. They've mentioned this in previous meetings. It'll be interesting what the language is, coming out of this meeting on that.
So this is basically moving closer towards yield curve control. Does that mean that bonds, then the yield should be capped to the upside in whatever area they target?
It's really interesting. When you think about yield curve targeting or yield curve controls, however you want to say it, it really comes down to what does the market think about can the Fed actually hold the target? If there's expectations of, rapid inflation or high rising inflation, then it becomes very hard for the Fed to maintain the target unless they really want to go in and buy a lot of bonds. If there's more consensus that the target makes sense, then you know what, the market will just trade at that clearing price, and everything will kind of move at that.
What are they signaling if they start talking about yield curve control and we haven't even gotten to 1%? Why do they need to control the yield curve? Our inflation was warmed by a basis point on the last read. It's not even close to anywhere near 2%. Why is this even a conversation, Jim?
It's a great question. I think if we look at mixed economic news, that we still have unemployment just about 7%, labor participation is coming down, small business closures, we're about to hit, I think we're already in the midst of a pretty large wave in COVID, even though there are vaccines, that's going to take some time. And, rising longer-term interest rates will be just another potential headwind to growth, and that's something that the Fed has been nervous about. And so anything they can do to signal the markets that they will try to remove any potential headwinds, I think they're open to doing.
Feels like we're kind of back in this area of this strange, almost hall of mirrors where, what is then the implication if there's not inflation right now, but the Fed wants to start positioning to make sure the bond market doesn't get out of control if there is inflation, then if Powell starts talking yield curve control, do people start thinking about inflation and then try and sell their bonds to test the Fed?
Yeah, that's a chicken and the egg problem. But it sounds like what you're saying. Yeah, it's exactly right. But the Fed has said they are willing to support higher than the average or higher than 2% inflation. They'd like to get there. They haven't been able to get there yet. So it's even though it is a little bit of a chicken and the egg, it's pick your poison. I think is maybe a better analogy where it's look, we're willing to do what we need to do, and if that causes some inflation, well, we'll deal with that down the road when it happens.
So if they do say something like, okay, we're going to target and buy bonds every time the yield gets to some percent or something. I don't know. I've never been around for a yield curve control environment. Does the market go like straight to that yield like it it would if a stock gets bought out. When Salesforce says they're going to buy Slack for a certain price, stock goes whoop, goes right to that price because they trust Salesforce is going to buy it there. Do we do the same thing if Powell gives us a target on yield curve control? Do we go straight to wherever that is?
I think that maybe not straight there, but we should go there in short order, and it might be because the Fed jumps in and buys a bunch to kind of reassure the market that that's where we're headed towards. But you're right. I don't want to say it's uncharted territory. Obviously, yield curve controls have been used in Japan, more recently in Australia. We've used them in the U.S. if you go back to World War II for a short period, or actually for a multi-year period, but relatively short when you're in my business and think about hundreds of years of data. But so it's not completely uncharted territory, although most of us haven't lived through it here in the U.S.
Okay, so Jim, in terms of the decision-making process and with your team's funds right now, and when you talk with clients about how to figure out where to place treasuries as part of the portfolio, for many folks that has gotten a smaller and smaller contribution given the lower yields. Is there a certain point where the yield does become attractive relative to what's out there, or is there still just better opportunity in looking at rotation trades? Or is there still a better way to kind of hedge equity positioning in other asset classes besides the treasuries?
Yeah, we've been talking about emerging markets for a long time, and emerging markets finally, popped a little bit this year. If we go back to the summertime, it was really, the tech countries, China, South Korea, Taiwan, that really led the charge. But, over the last 3 months, we've seen a diversification across many different emerging market countries. Brazil, Indonesia, Mexico, all up almost 30% just on the quarter. The currencies are looking nice, especially with the sell-off in the dollar. And so, emerging markets to us look really attractive from a long-term, called a 10-year expected return perspective. We expect, on average, about 8% nominal return over the next decade. The last decade hasn't been, friendly to emerging markets, but we're expecting the 2020s to resemble something more like the 2000s.
Jim, does an investor even need treasuries as a part of their portfolio to hedge? Because it seems like the equity market itself has had such wide divergences that we don't really get a lot of broad rallies. What I mean by that is, for the most part, the last couple months, on any given day, it's either the NASDAQ or it's the rotation. Either the NASDAQ's up, and a lot of times you get bonds up there too. Like yesterday, again, we had this day where bonds rallied from the open, NASDAQ rallied too, Russell turned all the way around. It's like you can almost be appropriately diversified within equities by just offsetting your tech and momentum stuff with small caps or EM plays.
Yeah, we still think there's a place in the portfolio for treasuries. We are bleeding out much of the yield, so from a just coupon clipping perspective, it gets tough. But again, we would never tell anyone to put their entire portfolio into equities. There are a lot of other asset classes out there. Unfortunately, on the bond side, things are looking expensive, and even if we turn our attention to credit bonds, the spreads are 40 basis points below their long-term average. In fact, corporate yields are about where break-even inflation is, so you don't even get a real yield or a real return for taking on the credit risk. I still potentially like gold. I think gold and silver still have a place. They've sold off from the summer highs, but still seem to be attractively positioned for, again, if we continue to see sell-off in the dollar.
Jim, the EM point, one more thing here in terms of how it relates to other positions in terms of the rotation that we've been seeing. And it seems like EM's kind of gotten looped into some of the outperformance of the Russell. Should folks expect that to continue? Does emerging markets, do they trade similar to the domestic value trade? Do they have overlapping properties?
They do to some extent. Now, in the way we look at them, it's much more fundamental based, looking at the actual countries and what are they producing, what are the multiples on those countries. So we see, we're much more comfortable with an emerging market position than say a small cap position or domestic, really, domestic stocks in general, trading at CAPE multiples in the 30s. Small caps are even far higher than that. So, when we look at emerging markets and we can say, you can trade at a CAPE multiple of 14 versus 30 domestically, it just seems to make a lot of sense to really, for investors to get out of their comfort zone and look, to other countries that maybe they haven't invested in the past.
Okay. Jim, great to catch up. Always like your thoughts here on the market. Thanks for joining us.
Thanks a lot.
Jim Masturzo is a partner and head of asset allocation and research affiliate.